Good evening, good morning, or good afternoon, depending on where you are. My name is Tony Windle and welcome to Grant Thornton's webinar, The Rise of the E-Tailer Global Indirect Tax Considerations. We're just a couple of minutes past the hour, so I think we might kick off. There's quite a number of participants now in, so thank you very much everyone for your attendance. So welcome to this Grant Thornton webinar. My name's Tony Windle, as I said. I'm a partner in the Australian firm. I am the Global Chair of Indirect Tax for Grant Thornton, and I'm pleased to present this and facilitate this session this evening, my time here in Australia. And joining me today are a number of my colleagues from around the globe. So we'll do some introductions in a second. Thank you for your interest in this particular issue. If we work through and I guess just to introduce who your presenters are today. As I said, my name's Tony Windle. Joining me today, we have Alex Bolf, the dapper gentleman from the UK there. Alex.
Thanks, Tony. Good morning, good afternoon, everyone. I'm Alex Bolf. I'm a director leading Grant Thornton's international indirect tax team in London. I've been with the firm for 12 years now, with quite a large focus on the digital economy, so advising digital service providers, but also retailers and e-tailers.
Thanks, Alex. And the other presenter we have today with us is Jeremy O'Neill, joining us from Grant Thornton, Singapore. Jeremy, we can see you on camera there.
Yeah, thank you very much, Tony. Good afternoon to everyone in Singapore and good morning to those in the UK. As Tony mentioned, I'm a senior manager within the GST team at Grant Thornton, Singapore. I've been with Grant Thornton for about 4 years now, the last 2 of which I've been in Singapore. Similar to Alex, I advise on a number of multinational companies within the e-commerce and the digital service sector. I will hand back over to Tony.
Yeah, thanks, Jeremy. And as we set out the agenda, I just want to set the scene as to why we as Grant Thornton are pushing this particular awareness campaign. And as we talk through the agenda there, I guess just setting that scene as to what's going on. We're all sitting here on yet another Zoom call or yet another Teams call. This one happens to be Zoom, as you know, we're coming out the back of, at least here in Australia, a fairly hectic year of COVID management. Our friends in Europe and the UK are doing a little bit more tough, and our guys, our colleagues in the US that are joining as well, or participants from the US that are doing it tough there as well. Why we're talking about this here is with a focus to how it is that the indirect tax function of organisations for e-tailers and retailers work around the globe, but with a particular focus on the rise of e-commerce, which has effectively come out of the back of, or an enhanced version of, from the impact of COVID. What we have titled this today is The Rise of the E-Tailer and the Demise of the Retailer. That might be a little bit sensational, but we can talk through why that is. But certainly around the globe, we at Grant Thornton are doing a lot of work as we have digital services, goods, services, software as a service, etc., crossing borders and working into territories that might not have happened previously. So what we're going to look at today is that impact of COVID and why it is that the e-tailer is becoming a more common form of commerce. Some of those common issues and considerations across all territories. And we're going to look at the distinction between a wholesaler and a retailer. Business to business has separate considerations, as does a business to consumer situation. We're going to look at those things there. We'll also touch on some of the technical pieces there around registration, reverse charge, SaaS there as well, as we work through some specific rules, not only from the Australian perspective where I can talk there, but from Europe and the UK, particularly topical with Brexit being what it is on top of COVID. So plenty happening in that space. And then I guess from an APAC and Singapore perspective there with what Jeremy's talking about. This is a session where we are recording this, but if you do want to ask questions on the way through, I'll be monitoring the chat box. And so I'll be facilitating the conversation. So please just feel free to ask questions on the way through via the chat box. I'll have that up there and I'll sort of facilitate that through, either answer myself if it's relevant or pass that to Jeremy or Alex as the case may be. But I guess to set the scene, why are we talking about the digital economy, and what are the reasons we're focusing on cross-border supplies? I'm a traditional GST advisor. I've been doing it here in Australia at least for 20 plus years since it was brought in, and I do a lot of work in the global space as a number of territories have brought in GST or VATs around the world, in Malaysia, Puerto Rico, the UAE, China, India, etc. I've been working with a number of our member firms doing that. But what's always been really interesting is the implications and how we manage indirect tax, and let's just call it indirect tax for the purpose of today, given that we call it GST here in Australia, but VAT elsewhere around the globe. What's always been really a topical or a really technical issue to manage is how it is that we actually deal with the cross-border transition and supply of goods and services, and more recently, those intangible services that we're dealing with. Because effectively at its very heart, we know that GST and VAT as an indirect tax is a consumption tax. But if we look at that through the course of the COVID, some of the stats that are going around are quite mind-blowing, actually. Some of the countries that we work with, or territories, Australia and New Zealand, has shown, for example, that the online sales that are actually working through this pandemic space have grown by nearly 50% in these lockdown periods. That's quite simply mind-blowing in terms of what that then means for the supply chains, and then also the indirect tax implications that come off the back of that. So with more and more consumers shopping online, sellers and online marketplaces are increasingly moving goods cross-border. And quite often those transactions have very complex indirect tax implications, and non-compliance can leave a number of issues on the table there in respect of revenue authority scrutiny. So it's interesting, really, as we're working through this COVID environment there, how it is that actually the tax authorities manage their VAT or GST to effectively ensure that there's no fraud occurring. As we know that our consumption patterns are changing, and the traditional goods and services themselves are also now in the intangible space, where we have software as a service, digital streaming, Netflix, Google, Amazon Prime, etc. All of those cross-border supply of transactions, supply of intangibles are also caught up in this conversation today. So at a global level, the increase of cross-border transactions really has resulted in tax authorities globally placing increased focus on these transactions. We know there's a lot more data matching going on between revenue authorities, and we'll talk about that from a specific geographic perspective soon. GST and VAT, by its very nature, is now focusing more and more on the destination principle rather than the origin principle. And what that means is that we're looking at where the real true consumption occurs. So if we're sitting here at the end of a supply chain in Australia, for example, where we consume online digital streaming here in Australia, the issues that we faced here in Australia for quite some considerable time was the fact that we were able to stream free of indirect tax from offshore suppliers of digital content. We were able to set up VPN networks where we could actually access American content. Now that's been closed now in respect to how the rules work, which we'll talk about. But that real consumption and that mapping of where that consumption occurs is important for those cross-border supplies. I guess what's interesting also there is that the fast-paced, evolving economy environment really has put pressure on taxpayers to keep up to date with what's going on. And these rules are changing. We're going to talk through some of those here today. So I guess that sets the scene. Maybe if we look at, before we get into the specific territories, just at a macro perspective, at Grant Thornton, we've got a number of our colleagues that specialise in retail and consumer products. In talking with them about setting up for this session here today, what they encouraged me to think about, and our fellow presenters here, is looking at where the particular territory sits in a supply chain. Here in Australia and New Zealand, we are generally at the end of a supply chain, and in an e-tailer scenario, the ultimate consumption generally occurs here, rather than from an outbound perspective for that consumption to occur somewhere else around the globe. So what that means is that we have a lot of inbound rules that force compliance for not only goods, but also services, and also those intangible digital supplies that are made. Singapore, on the other hand, and Jeremy will talk to that quite eloquently soon, is traditionally at the centre of physical trade of goods, and it's really a hub through which those goods would pass. So the rules need to be slightly different there, noting also that consumption actually occurs in Singapore in a manner similar to what happens here at the end of the supply chain in Australia. UK and Europe, by contrast, has a very highly interconnected network of trade across the communities over there, and very sophisticated tracking techniques as to how to actually map that consumption. And Alex will talk to that soon. And then we get to the US, which is a real patchwork quilt of how to actually manage the indirect tax, particularly around some of the digital pieces, but also some of the physical trade of goods. And we're going to talk to some of those specific issues there. But in the first 10 minutes there, hopefully that's given you enough of a snapshot as to what we're trying to focus on here today. At a macro point of view, we've got a lot of things moving around the globe in a digital and in a physical sense. The traditional retailer model, where you go down the high street and actually buy most of your goods from there, is sort of fading away. It won't be replaced completely, but certainly from an e-tail side of things, those retailers that traditionally have a bricks and mortar mentality are themselves also morphing into a hybrid model, just to compete with the traditional sort of e-tailers there. But that's enough of setting the scenes. What we might do now is actually talk through some of those common issues around the digital economy, and then we'll jump to the specific territories. Some of the things, or some of the work that we do at Grant Thornton as we work with our clients globally around their supply chain, and the considerations for retailers are issues such as where it is that they're actually making the supply of goods or services to. And from a core tax perspective, we call this mapping the actual transaction. So in this case here, what we're trying to look at in an e-tail context is where it is your consumers are actually located. It's quite often that you won't actually have a physical presence in a particular territory, but you will be making supplies to that territory. So what that does is give rise to a whole bunch of issues around how it is you actually track the physical location of your consumers. And we've got some particular guidance in the US, which is coming out recently, which Alex will talk to soon. But quite often what's happening here in Australia, for example, is that the ATO, our Australian Taxation Office, would actually look around things such as cookies or online delivery destinations as to working out where those customers are. The next thing, or major common issue that we look at, is whether or not the value of those suppliers exceeds a relevant registration threshold. And there's nothing consistent around any of the registration thresholds that the revenue authorities have set in the various territories. And we'll talk about some of that in a second. Some of the other issues that we commonly see for retailers are where it is that you're making suppliers of software as a service, that intangible online streaming style sort of service, not a traditional service is the likes of which is a grant of advice or something crossing border like that, but a real consumption piece there using software. Some of the other considerations are around some of the low value goods thresholds, which effectively would not trigger a registration, or even if there is a registration, would not trigger a particular GST or VAT liability. And then some of the other things we're thinking about there, and there's different rules for different territories, is where the actual supplier themselves is not making the supply directly to the consumer, but is actually making it through an electronic distribution platform or an EDP, such as eBay, Amazon, or the like. So those are some of the issues for the retailers. We're going to be focusing predominantly on the B2C, so the retailer space here today, but it'd be remiss of us not to focus on some of the B2B as well. So some of the considerations for the wholesalers, again, looking at where the actual work is carried out in an offshore jurisdiction. Quite often the rules for business to consumer differ from a business to business transaction and may not actually require the charge of a local GST or a VAT. So for example, those relevant concessions might not actually trigger a registration requirement, because what's actually happening in that instance there is those B2B transactions are ignored. Some of the other instances there for B2B or the wholesalers where a registered participant is selling to another registered participant may well mean that there's actually some form of reverse charge or self-accounting, in which case there's actually no GST, cash flow or output. And again, some of the other issues there around importing the goods is some of the things such as the Incoterms or the importer of record, but we'll talk about some of those issues as we go through the territories. So that's enough of the bigger picture side of things. We'll let an accent other than an Australian now take over there, Alex. So we might get you just to talk about some of the specific rules and issues regarding the B2C goods into the UK, please.
Yeah, thanks, Tony. I suppose I couldn't be talking on a webinar in mid-December without mentioning Brexit. So this is of course on the horizon, and under 25 days to go now till the end of the transitional period and the UK formally leaves the EU VAT system. So what does that mean from a VAT perspective, and in particular in relation to e-commerce? Well, we will leave the EU deal or no deal. Any free trade agreement that's announced, really from an indirect tax perspective, that will only affect customs duty, whether tariffs will be applied and at what rates. But the UK is having to create its own VAT legislation now, as it moves away from the EU VAT directive and being part of the EU VAT system. So one of the first things the UK is doing in this area from the 1st of January, it's removing the low value import VAT threshold. So from the 1st of January, new rules will say for any individual consignments of goods sent through the postal system, sent via a courier from outside the UK to a consumer inside the UK, that will now be taxable. There is a zero threshold, and there is no protection now by the border. Historically, a lot of non-UK businesses outside the EU, would have either relied on the import threshold, or they would have prepaid import VAT to allow those goods to go in. But from the 1st of January, because that threshold is leaving, we're now going to have a point where you have to charge VAT at the point of sale. So all B2C goods under £135 will be subject to VAT, and every single non-UK supplier will have to register for VAT. Under the UK system, you can apply for registration within 30 days of your first taxable supply. So really, we're now the first couple of weeks of HMRC accepting applications, because they will have tens of thousands, if not hundreds of thousands of applications. We're still a bit worried whether numbers will be received in time. But the good news about this system is VAT can be charged at the point of sale. And that is important because a lot of, the majority of B2C transactions are generally low value. They're fairly anonymous. You only have maybe a few seconds contact with a customer online. And you only have, that one opportunity to get the information that you need to drive a tax decision. If you don't collect tax at the right time, you have to eat that tax. You need to take that VAT out of your revenue, and that's going to eat your margin, eat into your profit. Next slide, please, Tony. So for just one before actually. So for B2B, there's going to be another change. So currently, for B2B transactions from goods coming from outside the EU, there's a customs border that currently represents the European Union, with import VAT payable when the goods come in by the importer of record. The big change post-Brexit, and this is to hopefully facilitate trade and prevent the customs border being a barrier to trade, is VAT will no longer be collected at the border by customs. Instead, for every single UK VAT registered business, if they're the importer and they own the goods, their VAT number and UK EORI number can be declared when the import declaration is made, and that VAT number will trigger an automatic deferral of the import VAT being paid. And instead, that VAT will be self-assessed as a reverse charge in the VAT return, an in and an out, an output tax, an input tax, and a wash it's a nil-net effect, and hopefully a good cash flow saving for imports. But that's if a business wants to deliver duty paid B2B, they will have to be the importer. They will have to act as the consignee. They will need a EORI and VAT number to defer that VAT, bring the goods in, but also remember that customs duty is also payable. So it's really important to get the classification of the goods right. So particularly for a lot of EU-based businesses, currently, because there's a single market and goods can move freely from an EU member state to another, commodity codes for customs purposes have only really been used for statistical purposes for the intrastat. But now this is actually driving a rate of duty, which is a hard cost. It's really important to get that right.
Just on that, Alex, sorry, I've just got a question from the audience here. We've got a question from Damien Palomero, just around EU warehouse and sale into the UK, talking about the sale from the European Union into, or sorry, continental into UK. Following Brexit, will there be a reverse charge applied? So
if we're talking about the movement of goods into the UK,
yes,
from the EU, yeah, there'll be a reverse charge, assuming that business is VAT registered in the UK. When the goods come in, that import VAT is deferred and then it's reverse charged in the VAT return. And there's no change to the normal rules of establishment. So if you are non-established, you don't have a fixed establishment here, you're operating under a kind of traditional 3PL model, where you have a third party with their warehouse, maybe they're providing a pick and pack service for you. That generally means you're still non-established.
I think that answers the second part of Damien's question there as well about the not established. Just while we've got you there as well, going the other way from Great Britain to Northern Ireland, a question from Peter McDermott, e.g. used cars normally sold through the margin scheme and the sale of those goods to the end consumer in Northern Ireland. What would the VAT implications be there?
So Northern Ireland has special treatment post-Brexit, because of the land border it shares with the Republic of Ireland, and the history of troubles over the years. Northern Ireland remains part of the EU for VAT purposes for supplies of goods. So that means supplies of goods between Northern Ireland and the EU. It's business as usual as today. It's an intra-community zero-rated supply out of Northern Ireland, or a intra-community acquisition with a reverse charge coming in. But then there are special rules between mainland Great Britain and Northern Ireland. So officially, in the eyes of the European Commission, there is an export out of GB and an import into Northern Ireland. But in reality, the way HMRC are going to manage imports and exports is VAT will still be charged on the sales invoice from a GB supplier to a Northern Ireland customer. There will be a customs declaration, but this will be simplified, it will be electronic, and the most important part, it will be free. So the government has set up a consortium with a number of different companies to run something called the TSS, the Trader Support Service. Any business that is dealing with goods that are flowing between GB and NI can register for free under the TSS. And that has a lot of quite detailed guidance in terms of the VAT and GST rules. It is quite a complex area. We still don't have 100% clarity on the Northern Ireland rules. They are somewhat fluid at the moment, but I would suggest that gentleman does log on to the TSS, signs up for registration, and there should be some good guidance there.
Thanks, Alex. Get you to keep going. Yeah.
Next slide, please. So, looking at the European Union, The 1st of January was also meant to be a big date in terms of e-commerce. There was a raft of changes slated to come in. These changes would have included ending value import VAT relief. So this is a trend. Something, Tony, I know Australia was one of the very first to do. And then we've seen this spread across the globe. The UK, of course, doing that from the 1st of January. But the European Commission has actually delayed this for a variety of reasons, possibly Brexit, possibly the impact of COVID, but also because a lot of the European member states they didn't have the technology to adequately collect the VAT. So there are new rules coming in, but 6 months later, so from the 1st of July 2021. So then the low value import VAT relief will disappear. So in effect, any good, even low value consignments coming into the EU from outside the EU will be taxable. They will be subject to VAT. And the current distance selling regime, the thresholds will in effect disappear. So at the moment, if you sell from one member state to another, you can generally charge VAT in the country where the goods are physically shipped from until you breach a distance selling threshold. So, around the 35,000 euro mark, or a bit higher, 100,000 euros in a few other European countries. Those thresholds will disappear from the 1st of July, and an optional registration and reporting scheme will come into play. This is called the one-stop shop, or the OZ. It is the new generation, or the next iteration of the mini one-stop shop, which is currently in place for digital services. And really, this is meant to be a streamlined VAT number, VAT return, and a single return allowing you to file VAT across all of the EU member states, and making one single payment to a tax authority. There's going to be 2 flavors of this OZ. One for goods within the EU, so European based vendors, or foreign vendors who are physically fulfilling goods, maybe from a warehouse in the EU, will end up charging VAT on all sales based on the location, and this will all be reported through one return. The other version is around import VAT, and will allow goods to, in effect, go through a green channel. So there'll be no import VAT physically levied at the border, but instead VAT will be physically paid through an online return. Next slide, please, Tony. So this one-stop shop comes into play from the 1st of July. So that gives a 6-month window for businesses to find another method of selling in the EU without the simplification. This is very pertinent at the moment to UK-based suppliers who want to continue selling post-Brexit B2C into the EU. There's a couple of options that are available to businesses. So currently, this is available to anyone fulfilling goods from outside the EU, and of course UK suppliers will join that list from January. So it's a bit of a hybrid model where the customer is strictly speaking the importer of record, so they're the named consignee, but the goods are physically delivered, import VAT prepaid. So this is a commercial service that a lot of third-party freight agents, parcel courier companies offer. They will make a declaration. They'll be engaged by the vendor, by the seller. They will be passed over monies to cover the cost of import VAT and clearance. That would be physically collected at the point of sale. But crucially, the named importer, the named consignee, is actually the customer. So they receive the goods with hopefully a good customer experience. They're not going to have to physically pay any import VAT. Their goods won't be held up at the border. But because they are the named importer, for VAT purposes, the vendor has no VAT requirements because their transaction is deemed to take place before the EU border. This needs to be implemented correctly. The freight agent making the declaration needs to ensure they can do this. They're confident of doing it, and they're able to make this work in every member state. 2 points to note: VAT can't be physically charged at the point of sale because it's not actual VAT that's being charged in the vendor's hands, but really they will calculate an amount equal to import VAT that they will collect and just pass over. So it's really proper to the consumer and it's proper to the customs declaration. The big drawback for this is if you have an e-com business that has a lot of returns, and some markets within Europe have a reputation for a lot of returns. A lot of my clients talk about Germany. I think there's a culture there, particularly within online clothing and shoe shopping, that a very large percentage gets sent back. Because the VAT that's charged is proper to the customs authority, it's not supply VAT, it can't be refunded. So that import VAT is lost, and therefore if the supplier wants to fully refund the customer, they're going to have to eat the cost of that import VAT. Next slide, please, Tony. And then the second option is to actually physically fulfill from an EU member state. So you're still within the distance selling rules for the next 6 months. So you may choose to import directly into a European country where you sell. That would lead to multiple VAT registrations, and also, possibly a dozen fiscal representatives that need to be appointed. But instead, you may want to strategically import into one member state. So countries like the Netherlands seem a logical logistical hub. There are some advantages there. You can apply for an Article 23 license with a local fiscal representative, which allows you to defer import VAT. And then once you fulfill those goods from that member state, as I said, you're then still within the distance selling regime. So business as usual under the current rules. Things to note: well, because you're fulfilling these goods from the EU, they're subject to local tax invoicing rules. This is often a surprise to a lot of US businesses selling in Europe, that under VAT legislation at the European level, also under consumer protection legislation, there are requirements in many countries, in fact the majority of countries, to issue tax invoices. So you need to ensure that your systems can produce these. VAT must be shown in the local currency, the reporting currency in that country. So even you may sell in your home currency on a website, you do need to factor in currency conversion and how that may be reflected on the receipt or invoice. Next slide, please, Tony. Right, so that wraps up my whistle-stop tour around the UK and EU. So we'll now pass over to Jeremy O'Neill in Singapore.
Thank you, Alex. Yeah, thank you. For those that haven't heard me present before, I do have a stammer, so if I do get stuck, please bear with me. And just by way of a basic comparison, Singapore actually has a very high registration threshold, which is currently $1 million Singapore dollars. And that actually applies to both businesses who are resident and non-resident resident, which is obviously very different to that within the European Union. And on the 1st of January 2020, Singapore implemented the overseas vendor registration regime, which is akin to the MOS regime within the European Union. However, it's important to note that at the moment, the scope of the overseas vendor registration only covers digital services. So those are the ones that Tony was speaking about during the background, and it doesn't apply to the supply of goods, which I will cover in a little more detail now. So as to Tony alluded to when setting the scene, Singapore typically has two positions within the supply chain of the e-commerce sector. The first one is obviously the Singapore consumers who are actually buying these goods from the online sellers and the electronic distribution platforms. In most cases, the orders would be approved and dispatched by the non-resident businesses or electronic distribution platforms, and then the goods would be shipped and imported into Singapore. Contrary to the other jurisdictions which we are talking about today, Singapore hasn't yet implemented any specific rules or regimes to address the tax gap actually created by the e-commerce activities of non-resident businesses, and actually still applies the low value import relief, which is currently at 400 Singapore dollars, which is equivalent to about 290 USD. So at the moment, the non-resident businesses can actually consign goods to the customer, and as long as the value of the goods is less than $400, there'll be no GST due at importation. But that is something that the Singapore tax authorities are looking at changing in the next couple of years. However, one of the issues that non-resident businesses do face is actually the practical challenges around the importation of goods into Singapore. Under the Singapore custom legislation, the importers and the consignees must have a unique identity number, which is only actually granted to Singapore establishments. In other words, a non-resident business cannot actually import goods into Singapore in their own name. So if the businesses were keen to do that from a commercial perspective, rather than consign them in the customer's name, they would actually have to use an agent. And this is something that that policymakers and the tax authorities identified just prior to the implementation of GST back in 1994. And to address this challenge, they actually implemented a couple of agency provisions within the GST legislation, which are specifically a section 33.1 and a section 33.2 agent provision, but I won't cover the differences between the two on the webinar today. But in short, what the agency legislation does, it effectively creates a GST fiction, where it treats the agent as the principal in the supply of the goods, and actually assigns all the GST reporting and subsequent compliance onto the agent on behalf of the overseas principal. In other words, the domestic agent will import the goods within their own name. They will pay any GST due, and then when the goods are onward delivered to the Singapore customer, they would be liable to account for Singapore GST on the local supply of goods on behalf of the overseas principal. And this is something that we've helped a number of clients come to terms with here at Grant Thornton Singapore. And this was in relation to clients which were both selling B2C and B2C within Singapore, and we were able to help them with the appointment of agents. We even facilitated the setting up of process documents and risk management procedures to ensure that the GST obligations were clearly defined and met with the agent as well. The second area where Singapore falls within the e-commerce supply chain is as a distribution hub, and this could be through a related party, or it could be a third-party arrangement as well. And given Singapore's unique geographic position in the globe, the policymakers here in Singapore identified the logistics and the international trade sector as a key industry for the country. And with this in mind, they actually designed and implemented a number of GST schemes to incentivize businesses to use Singapore as the location for their distribution hub. In principle, the schemes allows qualifying businesses to import goods into Singapore with the import GST suspended, and that's suspended almost indefinitely, thus resulting in a major cash flow savings to the businesses. And it therefore means that the businesses don't actually have to pay the GST on the importation and wait for it to be refunded or credited through their GST returns, thus saving companies potentially millions within their short-term working capital. And it's key to note that actually some of these schemes can be used in conjunction with the domestic agent principles, which I spoke about just earlier. And again, this is an area which actually doesn't apply just to the retailers, and we've advised and worked closely with a number of B2B and B2C companies with distribution hubs in Singapore to apply and get approval from the tax authorities for these statuses. We actually had a recent case with a client where as part of the scheme application, we were required to undertake a GST health check, and during which we identified a number of errors and irregularities within their GST records, and we were able to work closely with the client to quantify these and disclose them to the authorities. And because the client was forthcoming with the authorities, they were happy to waive any penalties in relation to the historic errors that had been made. And I think just a comment in terms of the tax authorities' approach. Within Singapore, generally, they elect to take a rather pragmatic approach, which was evidenced in my example just then. However, there are equally a number of cases where they actually proactively work with the electronic distribution platforms, with the internet service providers and card payment companies to target businesses within these specific areas, and in a number of cases, they've even proceeded with criminal prosecutions. However, these cases are generally restricted to those where the businesses showed intent and a willingness to deceive and defraud the authorities. So it is very much an industry where the Singapore tax authorities are looking closely at it, and it's probably an area where the rules are going to change in the coming years to align what we expect would be similar to the model in Australia. And on that point, I will hand back over to Tony, unless there's some specific Singapore-related questions.
Thanks, Jeremy. I'll pick up in a second. There has been a question, I think it might be directed to you. So is there import VAT in B2C hybrid system then?
So in terms of, we wouldn't necessarily have any specific rules in Singapore around that like they do in Europe. But so if you're selling with the consumer as the consignee, as long as the value of the goods is below the low value of registration, then there would be no VAT, no GST payable at importation, and the overseas business would not have a registration requirement. However, if the value of the goods is greater than the 400 Singapore dollars, then the Singapore consumer would actually have an obligation to pay the import GST prior to the goods being released by the freight company that would have settled the import GST at the point of importation.
Alex, have you guys got a quick 30-second answer to that from the UK and EU perspective there?
Yes. So the kind of hybrid model that I talked about, where the consumer is the consignee. So the VAT is physically paid over by the freight agent on behalf of the consumer. So it's really their VAT that they're paying over, and it's their relationship with the customs authority. So that there's no self-assessment, there's no reverse charge. In terms of the vendor's supply, that's even outside of the customs border. So it really is this just transaction just to get the goods through. It's the freight agent declaring in the name of the consumer and physically passing the money over so the goods are cleared.
Thanks, Alex. And I might just pick up on that just briefly when we talk about the Australian experience there as well. If we can move there to the slide. So the guys, Jeremy and Alex, have spoken about their experiences in their markets there. And like I set up at the start, there's a whole bunch of common issues that we grapple with in respect of the e-tailer model. The very generous 1 million Singapore registration threshold that exists there is not replicated in Australia. We have an Australian $75,000 threshold, which is one of the biggest issues. Just to answer the question, I think someone asked there before. I think, Ben, thank you for your question. The biggest issue we find for inbound e-tailers is a historical registration requirement. And when we talk about that, and I've made the point on my slide there about a highly aggressive compliance model from our Revenue Authority, the Australian Taxation Office, the biggest issue we grapple with is at what point in time did an online e-tailer tip over that very low $75,000 threshold? And when I say we've got an aggressive compliance model from our Revenue Authority, that actually involves what they call a market intelligence team, essentially scouting the likes of Instagram, Facebook, eBay, Alibaba, etc., and issuing very strongly worded directions and questions to head office of the relevant websites. We've had a whole bunch of US-based e-tailers for consumer goods some of which are digital subscription services for online content, for example, some of which are actually very low value $40, $50 goods that are sold in individual consignments from the US with postage attached to. But they actually have historical liabilities, given that there's a statutory review period of 4 years that rolls through. That $75,000 threshold can be tripped over very easily. So that's one of the first things we have to work out, is at what point in time does an e-tailer actually tip into the Australian GST system. For a long time, we had a low value threshold. It was previously Australian $1,000, at which point in time the low value threshold also morphed into essentially a business to consumer reverse charge model, where the actual consumer had to pay GST to the freight forwarder or consignment, or in most cases Australia Post on delivery, in order to release those goods and have those goods delivered to them. We don't have that now, because what Australia has brought in place, similar to a number of other territories, to answer the questions asked before, is we have a two-tier registration model here in Australia. The first, what we refer to as a simplified registration model, is where that offshore e-tailer can register for Australian GST to pay output tax, but is not eligible to receive input tax as a credit or a refund back. A lot of our clients who are in the intangible space, so the software as a service or the digital content, what's referred to as the Netflix tax, which has been picked up by a number of other territories, most noticeably South Africa, Japan, and New Zealand in the APAC region. What that simplified registration model does is essentially register the offshore e-tailer for Australian GST so that they can lodge output tax liabilities for the $10 a month subscription service, or the $50 set of cups or mugs that were sold online. Now, that's an important distinction to make as against an extended registration for Australian GST. And this is one of the other big issues we have, depending on the supply chain, such that if the online e-tailer actually is the importer of record, in my comment there about focusing on the Incoterms, if the online e-tailer is an importer of record into Australia, they will be charged GST on importation, for which they'd generally be entitled to a credit. So a simplified registration model would not be the sort of advice we would give to someone or to an e-tailer that is actually making the importation rather than the consumer. What we would recommend in that instance is that they would potentially envisage doing a full registration, in which case they're actually entitled to both import GST as well as input tax credits for local costs associated with making their domestic activities. So that registration threshold and the nature of which registration they're after is probably the first couple of issues we talk to there. I've mentioned there that we try and focus on the Incoterms. What we have to make sure of is that we actually count all of the suppliers that actually are connected with Australia, because what we're seeing in this COVID world is that, again, with the massive rise of the online consumption, of the online ordering, where goods can be filled or picked from Singapore or Hong Kong, we've got a number of very high-end online retail, sort of consumer goods products, where essentially what they do is they will package together goods, but also supplementary services as well attached to those goods. The intangible also counts towards turnover, and that 75,000 is pretty easy to trip over when we start talking about the numbers that come through here. Software as a service, so online, support services, streaming, etc. We know that there's a number of accounting programs, your computer, virus protection, etc. All of those are taxed under what we call the Netflix tax. However, when we're talking about registration and the requirement to register for GST in Australia for these e-tailer activities, there's a very important distinction where such that we're only talking there about the business to consumer transactions that count. If you are an online wholesaler that moves goods or services, which moves services to a customer in Australia who would otherwise be entitled to a credit, those rules change such that they don't actually make a registration requirement necessary. problematic when you have a blend of customer base in terms of who you have consumers as well as wholesalers there. So the actual profiling of your actual customer base is another important issue and another activity that we do for a lot of our clients, just to look at what actually counts towards that relevant turnover threshold. And the final point I'll make there, again, other than just belabouring the point that we have a very aggressive revenue authority who is very proactive about sourcing non-compliant offshore e-tailers, is that the e-tailers do have an option to be taxed through the main electronic distribution platforms. There are options, for example, for Amazon and eBay, what have you, to actually collect tax on behalf of an organisation that would otherwise not be required to register for GST here in Australia. So not commonly seen, because quite often an organisation wants to control its own destiny in respect of its taxation affairs, quite rightly so. But those sort of issues also arise. So similar in nature to some of the other jurisdictions there. We might just quickly do a whip around while I'm looking at the questions there. Alex, I do know that we're going to just quickly touch on the USA in the last 5 minutes we do have while I look to the questions, but if you want to maybe pick up on that, please.
Sure. Thanks, Tony. So the US, the key point here is there's no federal level VAT, but instead the states levy sales tax. There's no credit mechanism. It's charged on retail sales. There is a resale exemption, so if you're selling wholesale B2B for an onward sale, sales tax is not meant to cascade. Instead, the reseller is meant to provide an exemption certificate, which is a big compliance burden over there. There's no tax at the border, just customs duty. But the real complexity is there's over 10,000 different taxing jurisdictions for sales tax. And in fact, a normal zip code doesn't give you enough granular detail to work out how much sales tax is due. You actually need a zip code +5, an extra few digits to really tell you what side of the street someone lives on, because that may then drive a local tax that's due, because it's not just at a state level, it's also at a county level, municipality level, and sometimes it gets even smaller than that. There are surcharges and taxes for the fire brigade, for the MTA train in New York. So loads and loads of taxes. Next slide, please, Tony. And then historically, you needed a physical presence in one of those taxing jurisdictions to have to register and charge sales tax. That was completely thrown out by the Supreme Court 2 years ago in the case of Wayfair. Wayfair, the online retailer, of home furniture and other items. The Supreme Court threw out the historic nexus rule, and they clearly said, actually, in today's e-commerce world, the old physical presence rule is just no longer fit for purpose. So this basically means that a state can introduce what we call economic nexus. They can just put a distance selling threshold that has been set by the court and replicated by most states now in the US at $100,000 per year, or as few as 200 transactions in that state. The map you see on the slide here shows all the states that have introduced Wayfair legislation. As you'll see, it's virtually every single state in the US, with a couple pending, and the 2 states that don't are the 2 states that don't actually have a sales tax. Extremely complex, and actually, if you're selling to the US, I do say monitor the revenue by state and take advice, because the tax authorities in the US, are quite sophisticated. They have a lot of employees. They have offices in different states, different cities. And if you don't register, there's no statute of limitations. So suddenly that sales tax exposure can really creep up. Thanks, Tony.
Thank you, Alex. We have reached the end of the actual presentation. It's spot on time in terms of the top of the hour. There's been a number of questions on the way through. Our contact details are here on the slide. There's a number of specific questions still outstanding there, I think predominantly for yourself there, Alex, which given the contact details we have available, we might get you to pick up offline. But just in the interest of time, I'd like to thank everyone for attending today. Again, coming back to the overall theme about the rise of e-tail as to retail, particularly in this post-COVID environment. Hopefully you found that of use. Our contact details are here. We have the contact details of those that are registered, so slides will be sent out and recording available. So thank you very much for your time. Have a good morning, evening, or afternoon, wherever you are. Thank you.